Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.isc.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Okay, and that was just a synthetic call and a synthetic put. Now looking at the straddles here, that's to be long a call and long a put at the same strike price. As I mentioned earlier, this does incur a deficit to the account. If long, it would be a credit. It would be a credit if short. So again, going long gamma is going to entail, in this case, being long a straddle is going to entail a deficit. You'll pay up. And if you decide to short premium or you take on a short volatility exposure, you'll receive a credit for that. Again, if you believe volatility is priced too low in the market, you're long, and too high, you're short. There's some other machinations as well that could take place, which would necessitate you facilitating that and in long a straddle 1 month and short a straddle another month and whatnot. But we'll get into that in future workshops and in future courses we put on here for the ICE. In this case, we're long the EUI, which is the ICE FX Euro straddle. It means for a trader that owns the puts and the calls for a combined premium of about $8,000 per straddle in this case. And this is what that looks like. So we're long one. Throw that bad boy out there. Now, I want to apologize because the software that I use, CQG, can only do the P&L graphs for the options that trade on another exchange. But I just wanted to give you guys a representation of what those look like. But if you use the Interactive Brokers platform, they do a lot of cool things. And in fact, Interactive Brokers just came out with a new option portfolio tool set, which is pretty high speed and fits in. It should fit in very nicely with the ISE products. So if you trade on Interactive Brokers and you trade ISE products on Interactive Brokers, get a hold of Interactive Brokers and find out how to use the new option portfolio margining tools, and they can give you just a lot of cool stuff to do that. 4:53 here on the East Coast and almost on the West Coast. I moved from California in Las Vegas about 5 weeks ago, so it's still the Pacific time zone. It still shows its vestiges from time to time. Conversely, if we decide to short the straddle here, again, you see our upside is capped, but our downside obviously entails significantly greater risk. And in this case, to manage that risk, we would obviously delta hedge or gamma trade around that. Again, when you're short gamma, the more the market goes up, the shorter you become. The more the market goes down, the longer you become. And so as a result of that, the market goes up again, and we want to hedge off our gamma exposure. We actually go long to mitigate some of that risk. Conversely, if the market goes down and we become long the market and we want to hedge off the risk, we would actually short against that. And again, you're doing a little more babysitting when you're short gamma. You're actually doing a lot more babysitting, but you're hoping to capture that time decay, that theta value that can unfold as a result of that. Strangles, just kind of going over the metrics behind that as well. Purchasing a call and a put at different strike prices. It incurs a deficit to the account if long, incurs to the account if short. In this case, if we're long the ISE FX Euro calls and long the Euro ICE FX puts, similar to a straddle insofar as the buyer's bullish volatility and the seller's bearish. But it's spanned out just a little bit more, and that's what you see right there. If you look at the bottom component here, you'll see that this serves as the anvil, if you will, upside down or inside out. Boy, you turned me. Okay, that was a kid. I listened to the song. I listened to as a kid. It's bad. I know. I can't help myself sometimes. If you're short of strangle, like we talked about, the anvil being what it is, or I guess the trapezoid here, in terms of how that shape looks like. Again, you're doing a lot of babysitting, making sure that things don't get too hairy. You hear in the background, I've traded the news on them. I have positions out there right now, and so if some crazy stuff hits the bell, I may have to do something, but I don't see it happening right now. Not with the way things close today, but you still always have to be ready in the market. Okay. Oh, all right. When it comes to managing our gamma, questions that I ask myself when I put on a trade is, what's my exposure? Am I bullish, bearish, or neutral on price and volatility? How well do I think I can trade this spread? Or like, is the market in a rhythm? If the market's in a rhythm, then I want to be involved. Okay, I want to understand, that there's a flow to that, and if there's a good flow to that market, I want to have some exposure at it, and I want to be actively trading it. Well, being along the options and then delta hedging that off is a great way to make that happen. And then conversely, where do I think market volatility is going? If I think it's going to be subtle or calm in the next couple of weeks or month or two, then I'll play that accordingly. If I think it's going to be in rhythm, then I want to be long that market and go from there. I mean, there's nothing like trading a market that you're dialed into, that you're locked into. I mean, we've all had those days where, whether it's shooting a basketball or you're hitting a golf ball, or like you just never want to leave the driving range because you just keep clubbing, you just keep hitting the sweet spot of the driver. Well, that's what it's like when you're gamma trading a market that's in great rhythm. So that's the analogy I like to use when it comes to understanding how you gamma trade around an options position. Okay, flexibility. All right, I mentioned earlier that you typically see markets that are either trending or markets a little more range bound. And for those of you out there that are trend followers, right, you like to play moving average crossovers, you like to buy breakouts and whatnot, having in the backdrop a short straddle strategy that can collect time decay as the market chops around is a great way to really smooth out some of your returns. All right, I think if you asked all of us, all right, okay, if you gave me the choice of like make a lot, lose a lot, and then have your equity curve kind of all over the place, a lot of us would say, no, not so much. But if you gave us a chance to, like, every day, build my portfolio up, build my trading account up in a slow, consistent, steady manner, that's the type of return that a lot of us can identify with and a lot of us can really embrace. And so if you're a trend follower, all right, you like to play breakouts or breakdowns, whatever the case may be, then having in the backdrop like a short straddle, even a short butterfly strategy, which we haven't talked about today, serves as like a nice way to capture some time decay or time premium or theta decay, and really offset some of that dynamic. And then the idea being, of course, that you can trade around that and work it so the gains you make more than offset that if the market does trend and go in your direction. Conversely, if you're a counter trend style, all right, being in a long straddle can serve as a nice alternative strategy for your counter trend style. So it's a great way of smoothing out returns, but with all these things, it's incumbent upon you as the trader to manage risk. But what these do, again, is like I talked about, helps in defining risk parameters. It helps in compartmentalizing risk, and that's what derivatives are. So we can make that happen and go from there. So and that's, again, how you compartmentalize risk and how you can work that accordingly. So having a drink after the market, that does sound good, except I don't drink alcohol. But maybe like a Pellegrino or something. Actually, New York tap water is really, really, maybe the best in the country. So, so when we talk about these things, how do you do these, John? If you get into a straddle, how can you make it happen? Well, normally, like, I'll shop the spread down the pit to see and compare it against the electronic markets and whatnot. Depending which exchange I'm trading, in the case of the ISE, I'll go ahead and just do it 2 legs at once. I'll try and work the flow, and send out both legs simultaneously if I'm doing long. If I'm getting short, then I'll piecemeal into it because I don't want to get hung on a trade. And when I say hung, I mean that you end up getting one leg and not the other, and that's not a good thing. And there you go. All right. I want to get to the market stuff. Okay, so here's the meat and potatoes of this presentation. I just want to give a basic background. I know I hit a lot of stuff. I know I hit it really fast. There's a lot of things there that I have that I could have spent the entire class on itself, but I want to touch on that just to provide a background because, again, it looks like a number of people, maybe hadn't been exposed to some of those concepts, but at the same time, I still want to get to what I'm doing going forward. So I'm going to actually back out of this now.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.